Welcome to Value VestDaily. Today, we are diving headfirst into a seismic shift in the media world, a monster deal that could completely redefine entertainment as we know it for the next decade.
All right, let's get right into it. Today, January 20th, 2026, is a day that just fundamentally changed the entire landscape of Hollywood. The streaming wars just went nuclear. We've just seen an absolutely explosive move from Netflix. They have amended their blockbuster bid for Warner Bros. Discovery's key assets, and they've turned it into an all-cash offer. Now, this is not just some minor tweak, folks. This is a direct, high-stakes shot across the bow and a massive battle for media supremacy. It's setting the stage for one of the biggest industry shakeups we have seen in years.
And that really brings us to the billion-dollar question for every single one of us as investors. Sure, this deal could create a new media titan unlike anything we've ever seen. But with a price tag this high and debt piling up, you gotta ask, is this a brilliant once-in-a-generation bargain to acquire priceless assets? Or is it a classic value trap where a company is just massively overpaying at the top of the market? For anyone invested in tech or entertainment, the stakes could not be higher. Okay, so here's our game plan for this deep dive. First, we're gonna break down the nuts and bolts of this deal. Who's involved, what's the price, and what's the prize? Then we'll look at how Wall Street is reacting right now in real time. After that, we get to the most important part, your value investing playbook, where we're going to hunt for opportunity in all this chaos. And finally, we'll look at the big risks, the things that could blow this whole thing up. All right, let's roll up our sleeves and get into the nitty-gritty. Because if you want to understand the investment case here, you first have to understand all the moving parts of this massive transaction. We're talking about the key players, the eye-watering price, and of course, the incredible prize at the center of it all, a library of some of the most iconic content ever created. So the critical point here, the thing that changes everything, is the currency. The original bid from Netflix was a mix of cash and their own stock. And what's the problem with that? Well, Netflix stock can be pretty volatile. If you're a Warner shareholder, you might not want to trade your company for stock that could drop 10% next week. By switching to all cash at the same price, Netflix is taking all that uncertainty off the table. It's clean, it's simple, and it's a much more powerful offer. It's them slamming a pile of cash on the table and saying, we are serious, this is real. So why the sudden change? Well, Netflix didn't just wake up and decide to do this in a vacuum. You have to look at the timeline. After Netflix's first offer, Paramount saw an opening and jumped in with a hostile takeover attempt for the entire company. But Warner's board shot them down. So what did Netflix do? They came back with this all-cash move today, which is basically a strategic masterstroke. It's a direct counterattack to Paramount, designed to completely kill their rival bid and lock in the deal before the shareholder vote comes up in April. And let's just pause for a second and appreciate the sheer scale of this deal. $82.7 billion. I mean, that is a staggering number. And remember, that's the enterprise value, which is a really key concept here. It's not just the purchase price. It also includes the mountain of debt that Netflix has to take on from Warner's books. This is a company-defining bet. It's going to completely transform Netflix's balance sheet over. So for that $82 billion, what is Netflix actually getting? They're getting the absolute crown jewels of Hollywood. HBO Max, the legendary Warner Bros. Studio, DC Comics, Game of Thrones, Harry Potter, the whole shebang. But what's really fascinating is what they're not buying. The old-school cable networks, like CNN and TNT, are being spun off into a brand new separate company. And shares of that new company will go directly to the current Warner shareholders. It's a really clever structure. It lets shareholders get a huge cash payday for the studio assets while still owning a piece of the steady cash-generating cable business. Of course, a bombshell like this hits the market like a tidal wave. Wall Street's response was immediate and incredibly decisive. So let's break down the winners, the losers, and more importantly, the why behind all these stock moves. First up, the undisputed winner of the day, Warner Bros. Discovery. The stock absolutely surged, up 8%. So why the big pop? Well, the market is now basically saying this deal is going to happen. That all-cash offer from a serious buyer like Netflix gives investors a ton of confidence. The stock price is just racing to catch up to that buyout price, plus a little extra for the value of that new spin-off company we just talked about. Now, on the other side of the coin, what about the company writing the check? Netflix stock actually dipped about 3%. And look, this isn't the market saying they hate the deal. Not at all. It's a direct reaction to the bill. To pay for all of this in cash, Netflix has to go out and borrow an enormous amount of money. Their net debt is expected to balloon to over $20 billion, and that adds a whole lot of risk to their balance sheet. That's what's making some investors nervous. And then we have the third player in this drama, Paramount. Their stock took a hit, falling 4%. And this right here tells you the market's verdict. Investors are now betting that Paramount's hostile bid is completely dead in the water. With Netflix's stronger, cleaner, all-cash offer on the table, Paramount has been totally sidelined. Their stock is falling because that potential path to acquiring Warner just slammed shut. Okay, let's put this all together on our market scorecard. Just focus on that PE ratio column for a second. You can see Netflix trading at a high multiple of 35. The market sees it as a growth company. Then look at Warner and Paramount, trading at just 12 and 10. That's a classic old media valuation. The Why Watch column really tells the core story for each. For Netflix, it's a battle between the new debt and the powerful content they're buying. For Warner, it's all about collecting that payday. And for Paramount, well, the fallout from this raises the huge question, is this stock now fundamentally undervalued? And that question leads us perfectly into our main event. Because for value investors, this kind of massive disruption and chaos, this isn't a threat. It's a prime hunting ground for opportunity. So let's open up the playbook and figure out where the real value might be hiding amidst all the noise. Now, before we name specific stocks, we have to talk about the magic word you hear in every single merger: synergies. It's the core of the whole investment thesis. It's just a fancy word for the cost savings you get when you combine two companies. You don't need two accounting departments, two marketing teams. You merge them and cut costs. And in this case, analysts think Netflix could slash about $2 billion in annual costs. That money flows straight to the bottom line, making the new company way more profitable. So where are the opportunities? First, let's look at Paramount again. The market punished it, sure, but now it's trading at a cheap PE of 10, and it still owns a vault of valuable content. You have to wonder if it's the next takeover target. Second, think about Comcast. In an industry with this much craziness, Comcast's stable broadband business is like a fortress, just printing cash while everyone else takes on debt. And finally, you can't ignore Disney. A more powerful Netflix just proves how valuable premium content is, which only makes Disney's library even more valuable. A rising tide lifts all boats, right? Even the biggest ones. Let's get into some deeper metrics to back this up. We're using a metric called EV to EBITDA here. It's just a better way to compare these companies fairly, especially since they have such different debt levels. And as you can see, Paramount looks like the cheapest of the bunch. Plus, its low debt-to-equity ratio gives it a solid foundation. Comcast's broadband business gives it that defensive moat we talked about, and Disney's value is all locked up in its incredible portfolio of intellectual property. The numbers really do tell the story. And hey, if you're looking for a historical parallel, you don't have to look far. Just think back to when AT&T bought this very same company, Warner, back in 2018. That deal was messy, loaded with debt, and investors hated it at first. But what happened? After AT&T spun Warner back out, the new company's stock jumped 30% in 2 years. It just goes to show you that even these complex, debt-fueled deals can unlock a ton of value for patient investors who can see past the short-term noise. Okay, now before we get too carried away, we have to be really clear-eyed about the risks. A deal of this size is never a sure thing. There are some major hurdles to clear. So let's walk through the roadblocks and then look at what could happen to the entire sector if this deal actually gets approved. So what's the one thing that could just completely kill this deal? Well, while there are a bunch of financial risks, there's one massive obstacle that stands above everything else. And that hurdle is regulatory approval. The Department of Justice is going to put this deal under a microscope. They'll have to decide if combining the #1 streamer with a major Hollywood studio would hurt competition and be bad for you, the consumer. And approval is absolutely not guaranteed. There's also a political angle here. Some analysts think the current administration might actually prefer a deal involving Paramount, which could create a really unexpected roadblock for Netflix. But what if it is approved? Well, the upside could be huge, and not just for Netflix and Warner. Getting the green light would signal that regulators are open to more deals, which could trigger a 10 to 15% re-rating of the entire media sector. And in the bigger picture, with the economy looking pretty solid, a sector-wide lift from M&A could be a major tailwind for all of these stocks. All right, before we wrap up, here's the mandatory disclaimer. Everything we've discussed in this explainer is for educational purposes only. This is not financial advice, and it's not tax advice. Please always do your own research and consult with a professional before making any investment decisions.
So the board is set and the pieces are moving. What's your play? Are you betting on Netflix to win the long game, holding Warner to capture that premium, or are you buying the dip on Paramount, hoping it's the next domino to fall? Let us know your strategy down in the comments. Please subscribe, like, and share Value VestDaily for daily learning opportunities before you put your money to work. And one more thing, please put in a comment if you want us to deep dive into any specific high-risk/reward opportunities. Thanks for watching.